And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning. Welcome to the Tuesday edition of The Real Investment Show. That's right. It's Tuesday already. This week's just already flying by. It's about to be Wednesday, hump day, right around the corner. Then the best day of the week, Thursday, then Friday, and it's Christmas. So it's just going to be there that quick. John's already ready. We talked about this yesterday. Getting the Christmas trees out.
Hey man, January's already gone. I don't know how that happened.
I know, right?
I mean, I just felt like I put the tree up, in like 2 weeks it's going to feel like I'm going to bring it back down again.
I know. This is my wife's most frustrating time of the year. We were driving around over the weekend, running some errands. We went to Costco, did some other stuff, and we're driving back through the neighborhood, and somebody still has their Christmas tree up in their house. Yeah. And she's like, "That is criminal." Yeah. So yeah, take your Christmas tree down. Time to put them away. Anyway, all right, a couple of things going on. Yesterday, ISM manufacturing came out, and it was much stronger than expected, and in fact, jumped back into expansionary territory for the first time we've seen in probably the last year or so. Came in about 52.9, so back into expansion for the ISM manufacturing. ISM services already in expansion, so that's starting to kind of pull that soft data that we watch back into better territory and catching up with some of the hard data that we track. Hard data has been beating estimates now for the last few months, so that's been, the surprises of hard data has been very strong. Soft data has been missing those expectations, but now starting to play a little bit of catch up. So we're starting to see that kind of pull in, and this kind of feeds into that whole reflationary narrative that the market's been trading off of this year. Small caps, mid caps have been doing well. Materials and industrials have been doing exceptionally well up to this point. And those are very, very overbought sectors, but they were running ahead of the actual economic data. And so that data is actually starting to now kind of play a little bit of catch up. Now, this is just an initial set of data, right? And the question now will be whether or not that it's, has longevity to it. Are we going to continue to see more economically robust data over the months and quarters ahead, which would kind of align with this reflationary narrative? And of course, there's a lot of risk to that, as we talked about at the economic summit that we just had a couple of weeks ago. And as we've written about here over the last couple of weeks, the whole reflationary narrative is fine. It's based on this idea that we're going to have, a larger than normal tax refund season coming up in April. So people are supposed to get like $1,000 back in their tax refund. Got to be a little careful with that analysis, because everybody says, oh, they're going to have these big tax refunds. They're all going to go out and spend it. That's true. That's a very true statement. But it's an incremental increase. If you got $800 last year and you get $1,000 this year, you have a $200 increase over what you spent last year. So the incremental increase is what's important to the economic impact. And there will be definitely some impact to that. If people do indeed get larger tax refunds this year, there will be some incremental impact to the economy. But, expecting very, very strong economic growth, that may be a little bit disappointing just because of what happens there. But it's not just that, right? We also have the deregulation coming through from the OBBA. There's also expectations for increased CapEx spending, of course, with all the data center build-outs and all that. That's going to lead to that multiplier effect in the economy of building out roads and bridges and grids and all those type of things to go along to support these data centers. So all that feeds into this idea of this reflationary narrative. And as we talked about, when you start looking at things like industrial stocks, they've been doing very, very well here. In fact, they just hit an all-time high yesterday. Basic materials kind of in the same camp, doing very, very well here. Also, have had just a really, really sharp run, particularly since December. Really, this run in basic materials really started in December, and really kind of the same thing that we saw with the industrial complex. It was just kind of this narrative that started in December and then kind of took off. And that's fine. And this is part of that early narrative within this idea of this reflationary trade. just be a little cautious with this, only from the standpoint that as I'm talking about this now, these sectors are very, very overbought, and they've gotten a bit ahead of themselves. They've been running hard here. And yes, we're going to have this economic reflationary input, but again, valuations are going to feed back into this. Will the growth rate, catch up to support where these stocks have already been running to? So, and that's going to be one of the challenges this year. So, as always the case, just when things are running like this and getting very overbought on multiple levels, don't forget, as we've talked about every time we see this, is just take your profits, rebalance your risk. That doesn't mean sell everything. It just means look for opportunities. Remember, our job as investors is to look for things that are not performing well but have good, strong fundamentals, and look for that rotation there. Remember, earlier this year, back in early January, we were talking about the fact that staples were extremely oversold, and that they were out of favor. Nobody loved them, and this was back in October, November, and early December. Nobody wanted to be in staples, and then staples have had just this huge run here since the beginning of this year. Again, it's that rotation, and so when you have these rotations like this, where money flows into things that people hate, they're eventually going to rotate back the other way. So again, just don't forget to take your profits. It doesn't mean these runs are over by any stretch of the imagination, but take some profits along the way, and then that way when you do eventually need to come out of that sector and rotate to another sector, you've already captured some of that gain. You don't wake up with a big decline in your portfolio because something happened in the markets that just kind of freaked everything out at the moment, and money kind of runs in the other direction. Energy has, of course, been one of the areas that we've talked about a lot previously, and finally we saw that breakout in oil prices, and that has been quite interesting here, because remember, we were talking about oil prices getting very oversold previously, late last year, and that we were kind of positioning some stuff in the energy sector, expecting a rebound. So we saw that yesterday. Energy prices got hit because of kind of what's happening in the whole commodity index itself right now, just kind of an unwinding of some of that leverage. But again, this kind of rising trend line has been supportive of energy stocks, which also, as we've been talking about, are now getting decently overbought here. So again, in the energy complex as well, this was a good trade, and it was a good setup here to own energy stocks. That's worked out very well. But now it's time to kind of rebalance back to targets, take some profits, and reduce that risk. Areas that, of course, have been just still kind of lagging here, in particular, looking at utility stocks. Now, utility stocks are always kind of that, kind of that safe haven narrative, that safe haven play. They are very, very out of favor right now. If you look at a rotational setup in your portfolio, probably one of the areas we're going to see eventually catch some flows, and that's going to be if something happens in the stock market itself, and the broader market starts to really come under pressure, we're going to see a rotation probably back into some of these more defensive areas that have higher dividend yields, those type of things. So again, just some things to kind of think about within your overall portfolio. Okay, with that all said, just talking about the markets in general, here's what you need to know before the bell this morning. So yesterday, the markets rallied back off. We saw this rally back up into kind of near all-time highs. We're going to probably try to see that over the next few days. We're going to see a little bit of weakness in the markets, a little bit of volatility here, because markets have really kind of been struggling within this kind of rising uptrend. And again, this rising uptrend has just remained a very stable state right now. We just kind of continue to rally through here. That there we go. We've just kind of been building this wedge that as the markets continue to go up, we kind of hit the top of this wedge that we've been building, this kind of rising trend line, and then we sell off again. We just did that recently, came back down, hit the 50-day moving average, rallied off of that, hit the 20-day moving average, rallied off that. So we're still kind of pushing into that kind of consolidating price pattern. At some point here, this market is going to break out in one direction or the other. Most likely, it wants to try to break out to the upside. It's going to need some catalyst for that. Well, I don't know what that's going to be, but there'll be something that kind of gets that market moving. I would suspect, could be something like NVIDIA's earnings towards the end of the month. If they come in really well and they kind of support the whole AI narrative, maybe that gets the mega caps back kind of in the lead, so to speak. And yesterday was a good example of this. Apple, Google, were driving markets yesterday, and that's why we had kind of that nice trade yesterday within the overall markets. But we're going to need some kind of catalyst to break out of this range to the upside. If we can break out of this range to the upside, 7,100 becomes the new target for the S&P 500. So, there's some decent upside here, not a tremendous amount, but again, we could get some push here. A break to the downside, of course, is going to lead us to a push back down towards 67.60 on the S&P. So there's kind of your trading range right now within the markets, and just kind of from a risk-adjusted basis, just something worth kind of paying attention to within the overall markets. Just as we're just kind of looking, there's very, very high levels of complacency right now. The kind of the fear within the markets has just been a very, very low beta process up to this point. And as we kind of continue to watch volatility in particular, we kind of see these little spikes, but then immediately we get kind of complacency come back into the markets. And so we get this little spike up in volatility, market sells off a bit, we go right back down to the lows of that. But the one thing to pay attention to is we are getting this bit of a rising trend line in volatility. So that normally happens before you get a little bit bigger correction. And again, as we expect, sometime this year, I would suggest maybe April, May, maybe later this summer, we're going to see a 5 to 7 to 8% correction in the markets for whatever reason. Could be a political policy issue, could be getting prepared for midterm elections coming up if there's concerns over that. But there's enough catalyst out there to create a bit of a pullback in the markets. Again, 5, 6, 7, 8% would not be surprising at all. So just something we be prepared about, because that's what this kind of rising volatility suggests, is at some point we're going to break, volatility is going to spike, and markets are going to pull back. So again, this is why it's important. Make sure, and I know things are really easy right now in portfolios, but go through your portfolio, rebalance risk, take a look at where you've got big gains, take some profits there, rebalance areas that are kind of more safe haven type narratives, because again, when you get that correction, you'll appreciate that you did it. All right, that's what you need to know before the bell this morning. We'll come back, pick up with John Penn on Two Dads on Money, talking about chasing performance this morning. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Of course, it is Two Dads on Money. John Penn joined this morning. John, how are you?
I'm good. Good morning.
You're here?
I'm here. Thinking about Christmas trees already. I'm here.
Hey, got coffee?
I got my coffee. All is good.
All right, perfect. So this morning we're talking a little bit about the trap of chasing returns, and this has been really important as of late. We've talked about this a lot because we've seen, whenever things are doing well, we create some type of narrative around it, and we just, I've got to get into this asset, and we see this a lot even with our clients.
Yeah.
There's like when something's doing well, it's like, oh, we need to be in that, and then usually that's right towards the end of some type of move. Bitcoin's a good example. When Bitcoin's doing really well, we get phone calls. Everybody's like, oh, I need to put 20% of my portfolio into Bitcoin, and then when it falls 20%, it's like we don't get any phone calls. Yeah. So, but this is the one mistake that investors of all ages, and it's more detrimental the older you are to chase returns than it is when you're younger. You can get away with chasing returns when you're younger, but you actually pay a much bigger penalty than you expect. And this is the one thing that we don't think about. The financial media is really good about selling you products, and then they tell you, for instance, like, oh, just buy an ETF, passive index, just buy an ETF, and you'll get, growth of the markets over time, et cetera, so forth. It's not bad advice if you're young. You're going to get there, and you're going to get average returns over time. But the true trick to investing is buying things that nobody else wants and sell them when everybody else wants them. And this is the one challenge that most investors get wrong, is because when things are running, we all buy the things that are going up, and we don't want to own the things that nobody wants. Like, for instance, as I was just talking about a minute ago, nobody wants utility stocks right now. They're very cheap. Fundamentally, they're cheap. Price-wise, they're cheap. Technically, they're cheap. Nobody wants them because they're not performing. It's like, why would I buy that when I can buy this over here? AI stocks have been under pressure lately. A lot of those companies are getting pretty cheap. Nobody wants them right now because we're chasing industrials and materials. Eventually that's going to change, and where we want to be positioned is when that rotation occurs, we want to catch that rotation as it happens.
Yeah, it's almost some conversation. I get a little concerned because you were talking just a moment, and kind of when you were going through kind of before the market, you were talking about markets or investors being a little complacent. I get that sense right now from a lot of the conversations that I'm having with prospective clients, where everything seems very easy right now.
Right.
And I think there's a group of investors out there that are getting lulled into return expectations that are just not the norm. I mean, they're looking at things like silver. They're looking at even silver miners, right? So you look at even just the silver ETF, SLV.
Right.
You look at that last year, it was up 145% last year. And then if that's not in a portfolio, it's like, well, why didn't my advisor buy that for me? Why don't I own that?
Right.
Why isn't that part of my portfolio?
Sure.
And I think we, as investors, I think we rather than focusing on our portfolio as a whole, like looking at what I call the forest, we start nitpicking at the trees, and we let that one tree right there dictate how we feel about our overall situation or how our portfolio is doing overall. But like recently, I think investors are not only, I think there's investors out there chasing returns, but I'm also getting calls from prospective clients who aren't happy with their current advisor because they feel that their current advisor didn't keep up with the markets last year.
Right.
But then as I talk a little bit more with the prospective client, I'm like, well, how do they have you positioned? And the prospective client says, well, I told my advisor I'm a more conservative investor and I'm really concerned about volatility. Well, then it's like, well, if you're concerned about volatility, and if you tell your advisor you're more conservative, and your advisor positions your portfolio more conservatively, then how would you even expect to meet what the market does? It's like, what you got to think about this a little bit, right? So I just think, but I think there's a group of us out there where we look at these areas of the market where returns are doubling, and we somewhat expect, well, I should expect certain positions in my portfolio to double every year. And that's just not the norm. But we get so focused in on that one, it's called framing, where you focus in on one investment and you let that really drive your feel of success, and it can really lead you to make some knee-jerk reactions that longer term can be very detrimental.
Right.
I think.
Well, yeah, no, and I get this all the time.
Yeah.
So my job within the firm, right, is for you guys to go do the planning part.
Right.
And then you sit down with the client and say, okay, here's your financial plan. You need 6% rate of return to meet your goal over time. And so you send that to me, and I build a portfolio to generate that rate of return. And then they're like, and the reason that they're in this position is they've told you, oh, I'm very conservative, I don't want volatility risk, those type of things.
Right.
But then, again, at the end of the year, they're going, okay, well, the market was up X, and my portfolio did this. Did I beat the market last year? And that's the whole wrong view about investing. And then this is why investors wind up not doing well over time. And again, the statistics bear this out. If you take a look, Dalbart's done studies now for the last 35 years, and they survey retail investors across the country. And what they find out is that every single year, the average it doesn't mean everybody. There's some people that do very well for themselves, and people and everybody in our chat is a genius, right? Because if you ever read our chat, everybody in our chat is just killing it, and that's awesome, and I'm very proud of you guys. We have the best chat on the planet, financially wise. But the average investor underperforms the markets by 3 to 4% every single year. And it's not because they're, investing wrong or whatever, but it's because they're making mistakes. They're buying high, they're selling low, they're doing exactly all the things that you shouldn't do. And again, we focus on the one, this happens to us a lot. For instance, we bought Philip Morris, and Philip Morris was down after we bought it, and everybody's like, well, why do we own this dog, right? Well, now it's performing great, plus they're picking up a 5% dividend on top of it, and now they love this stock, right? But everything goes through cycles, and this is the thing that we forget, is that we just, and we tend to extrapolate things, right? So something's going up in price, and we just start coming up with narratives that it's just going to go up in price forever. And eventually you're going to have corrections, because that's just how markets work over time.
Yeah, and I see that right now a lot in that precious metal space, especially with silver. And look, many clients that I work with, as a part of their overall diversified portfolio, they have some of their overall portfolio. They own gold or some precious metals in some shape or form.
Absolutely.
And it's more of a position of some additional diversification, but it's not 30, 40, 50, 60, or 70% of their overall net worth. If it is, great. Please tell me you're taking profits along the way. Right? But I think there's a narrative right now around some of these areas where it feels safe because the media is talking about it. There's a lot of hype around it. Friends, neighbors, they're all talking about it. And so there's momentum behind it, so it just has to keep going up, right? And well, why am I not in this? So I'm just going to get in it now. And these asset classes have already run. Could they continue to run? Could they continue to be stronger? Maybe. For all of those that are invested in it, I hope so. But my fear is there's a lot of people making this trade that shouldn't be, and because it doesn't really fit their persona of risk. Because I think the narratives and headlines, I see everybody else doing this. It's like a herd mentality. Well, I'm going to jump on this trade too. And that's typically where I see folks get burned.
Right. Well, it's the momentum that drives the price. And this, it's interesting because when you talk about any asset, right, there's a fundamental basis behind it. Supply, demand, imbalance, whatever it is. And that equates to some risk premium for that asset price. So, there is a supply-demand imbalance of silver in terms of what we can produce versus what we use. So that does justify that maybe silver shouldn't trade at 20, maybe it should be at 30, or maybe it should even be at $40 based on that supply-demand imbalance. Everything above that premium is speculation and leverage. So, and again, in the futures market, commodities markets in particular, it's all driven by futures, which are highly leveraged. So you get a ton of leverage and a ton of momentum chasing this, and of course you have all the people buying the 2x leveraged, ETFs and everything else on these metals, 2x leverage on miners, etc. All that demand push, right, pushes the prices higher. Well, we forget that there's a natural gravitational pull. The further that we get away from that fundamental basis, the greater that gravitational pull is back to that level, and eventually you're going to get those corrections. And this is what we talked about this a little bit yesterday on the show, is that it's interesting. People were piling into this precious metals trade because they said, oh, the market's going to crash. And when the market crashes, I want to be in metals. But markets don't crash 30% in a day. Metals can. And this is the thing that unwinding of leverage can happen so quickly. And it was interesting because I just had this conversation with a gentleman like 2 weeks ago, and he was like, I want to put 30% of my portfolio in silver. I like, you can do that. I would highly suggest you don't, because this is going to have a very sharp reversal. Now, when it has that reversal, then buy it, right? And so now you're kind of getting that setup to where, look, the silver's bouncing today. I would be careful buying this bounce. There's a lot of people trapped that were buying the very top of it. They're now trapped in that position, and they're going to look to exit on this rally. And if they get more margin calls, which is very possible, If the CME hikes margin rates again, increasing that collateral value, that's going to increase margin calls once again. So just be careful chasing this initial bounce. Typically, just from a technical basis, when you get a big sell-off like you had, you have a lot of trap longs, you get a bounce back in whatever asset price it is, then you get a retest of that low. That's the one you want to buy. If it holds that low, if it sets new lows, then you just wait till it finds its new bottom. But just be careful buying this initial bounce. There's a trade here that could last for a few days because there's still a lot of speculative momentum. There's still a lot of this real bullish bias for metals in particular. So there's a decent tradable opportunity, but if it doesn't make new highs within the next few days, I would take profits.
Yeah, and this could relate to anything that's kind of quote unquote hot out there in the market. It's just that right now, most of the questions I'm getting is about silver and just what our thoughts are around silver. That just kind of seems to be what's hot in the market right now. But this could, all of those points that you mentioned, Lance, that could relate to whatever's hot in the market. And I think my concern is that investors, they're reacting to this, and it really sways them from their long-term strategies. And I mean, I spoke with a gentleman about 2-3 weeks ago whose portfolio was set up to be more conservative, and just frustrated that there wasn't more participation in the upside of the market. And so we had a really good talk around, well, let's really talk about not just your risk tolerance, but what is your risk capacity, like financially. So it's one thing from a risk tolerance standpoint, from an emotional standpoint, how much risk can you really take? What is your risk persona? But then as a fiduciary, I also have to look at, well, what is your capacity for being able to take more risk just from a financial position, right? But this really came down to risk tolerance because they wanted more upside performance, or they were frustrated that there wasn't more upside return in the market. But then I said, hold on a second. Because they said to me, I can take risk. I'm a risk taker. I am aggressive. And I said, no, you're not. I said, are you not the same person who called me last year when markets were melting down after the post-Liberation Day announcement? Markets were down 16 to 19%. You were down less than a quarter of a point. And you were telling me that you weren't able to sleep at night. It's like, let's really talk about this here. So I think, my concern is like folks are making these knee-jerk reactions because these, in my mind, these are speculative moves, but they feel very safe.
Right. But see, it's more than that. In my opinion, it's more than that. Is because it's all the media, it's the press, it's everything else. Because every time you turn on the media, it's like, there's some guy out there's like, silver's doing this today, gold's doing this, whatever it is. And it doesn't matter what the asset. AI stocks are doing, are going to the moon, and so it's and it just kind of keeps running in that direction. When you have that momentum behind the trade, it just kind of keeps pushing that direction. And it seems certainly safe because it just never goes down. Every asset price eventually corrects. Every asset price eventually goes down. And that's where kind of the rubber meets the road. And again, to your point about volatility, and I see this with I get the phone calls from clients and everything else about their portfolio and questions and concerns. It's like, oh my gosh, this one position in the portfolio is down. Why are we still owning this? We need to put everything into this other position over here that's going up. But as you started out the conversation with, is don't forget, a portfolio is like a car, and there's lots of moving parts that make it work. And just because you have a tire with low pressure, you don't get rid of the tire, you just fill it back up and go, keep on going down the road. But this is, we start making, because of this media input, we get this feeling that there's no risk. Oh, everybody's doing this, everybody's in it, I'm not in it. It's kind of this keeping up with the Joneses type, attitude that occurs. And when I go to parties and I talk to people, it's like, they're in silver and I'm not silver, whatever the asset is, right? I'm in Nvidia and they're in Nvidia and I'm not in Nvidia. And this narrative has just cycled over the last 5 years. We can just go back 5 years ago and go, I went to a party and everybody was in GameStop and I'm not in GameStop. Why are we not in GameStop? And then it was, I went to a party and everybody's in SPACs. Why am I not in SPACs? And there's reasons for this. Everybody's in Nvidia in 2022, coming out of the bottom in 2022. Why are we not in Nvidia? Those types of things, and it occurs. So now we're on to silver. And this will eventually end and then we'll go to the next one, whatever it is. But this is why it's important. You can gain exposure to these things, but you want to manage that risk because eventually all these runs end, and they tend to end rather badly, and that's just how markets work over time. And it's very fascinating to me because, again, everybody's so concerned about the valuation of the market. Everybody sees a bubble in the stock market, but they don't see a bubble in the commodities markets, right?
Or what they're specifically concentrating themselves in.
Exactly.
Yeah.
There's no bubble in what I'm in.
Everybody else is in one there.
Yeah, exactly. Everybody's else in bubble, but not me. That's the big risk.
Yeah, and I think sometimes where I spend a lot of, I really like, we all like to teach and educate, but I think sometimes as investors, it's very easy to look at, here's this diversified strategy that we're taking for our money to participate in the market and grow, and we want to fight inflation and fight taxes and have our portfolio grow to support our lifestyle moving forward, and we want to protect if markets get volatile to the downside. But then we look at, well, here's what these hot areas of the market are doing, and it's very easy for an investor, I think, to compare, well, here's how this hot investment is done compared to this strategy. And the problem is those areas that can run very hot in the market, whether if it's precious metals or if it's a commodity, whatever the hot topic is of the day, at some point that's going to look a lot better perhaps than maybe a diversified portfolio strategy. And I get it. We're people. It's emotional. Yep. Like dealing with our money, it's very emotional. It's like, well, I'm earning this, but boy, I sure would like to be earning this. But why am I not earning this? And I can see how it starts to really affect, how we view risk tolerance and how we can somewhat, change as our approach as an investor. And that's usually not the right approach to take.
Well, I think there's a big misconception between, and I've talked about this on the show before, which is there's a big misconception between risk and volatility.
Yeah. And,
price volatility is just a function of being in the markets. And a good example, last April, right? We have, the market's down 19%, peak to trough, and, everybody's panicking in the media, and it's like, oh my gosh, the world's ending because we have tariffs and all these type of things. And we had the most negative sentiment and positioning that we had seen in the markets since 2008, since the bottom of 2008. Now, remind you, in April of last year, we were down 19% over the course of a few weeks, and we had the most negative positioning and sentiment since the financial crisis.
Yeah.
Which just goes to show you that decline in the market, people were just completely on the wrong side of the market. They become so complacent in the market, so used to markets not having big corrections that was just a complete shocker. And they just all ran in the other direction. And of course, that was the bottom of the market. Markets took off after that. That's why we were buying on April the 7th, because you don't get those types of readings very often. And when you get those types of readings in the market, that's your opportunity to buy, not sell. But what were people doing? They were selling. They were getting out of the markets when that correction happened. And that's the thing you don't want to do is, and put yourself in the position that my portfolio is taking such a big hit now from being over leveraged into the markets or whatever it is, or too one-sided into a particular area of the market. And when that correction occurs, my initial response is to get out, not being, okay, I've in a position now where things are cheaper, I want to start buying whatever it is. Again, if as long as I believe in the narrative and believe in the story, believe in the fundamentals, you want to buy things that are cheaper, but yet most people react just the opposite, which impairs the returns over time. But this is the point about risk and volatility. April of last year was just a volatility move. That's all it was. Risk is the amount of money that you impair financially. In other words, how much money do you destroy permanently? That's risk. And risk is not understanding that as you're talking about, is that if I want a 5% return in my portfolio, and I go to John and say, John, just give me 6, right? Just give me 6. That's a 20% increase, 1% of 5. That's a 20% increase in the amount of risk or gain that I'm wanting, right? I just want to increase my return by 20%, 5 to 6%. But that's over 100% increase in volatility that I've got to pick up, or risk, because it grows exponentially. And so when you start pushing that risk on, so it's like, oh, no, John, I know I told you I was conservative. I just need a 5% return to meet my goal, but I really would like 12, right? The amount of volatility that you've got to pick up to generate that 10 or 12% rate of return, markets are just throwing off 12% a year. It can't be that hard. But when the market corrects, it's going to be large. And that's the thing that you've got to be careful of, because you have to be able to survive that downturn without completely destroying your capital. And risk is the destruction of capital that is non-repairable. In other words, you destroy capital and now you have less money to invest, and now you cannot repair that loss except over a very long period of time. And that means all those years that you're underwater from being break even, just trying to get back to even. It's like, this is one of my favorite stories of the markets. They go, yeah, it only took the market 13 years to get back to even after the dot-com crisis, right? But if you were just invested 13 years later, you're back to break even and you're making money again. That's 13 years of 6% compounded rates of return that you did not get. So even though you're back to break even, if you lose, let's talk about 2022, good example, right? So I just want 6% a return a year. So I get 6% return in 2019, I get 6% return in 2020, 2021, and then I lose 20% in October through October of 2022. Okay, that's fine. I didn't get back to break even until the following year. So that's a year of a 6% rate of return I did not get. So the next year I have to make up not just 6%, I also have to make up the 6% I didn't get before. So now I have a 12% return. And if I don't make that the next year, that now compounds onto the next year. And this is why when you look at people's returns over what they say they're going to get over time, it's like, oh, here's my this is the huge fallacy in the financial markets. It's like, oh, markets compound. No, markets do not compound returns. Returns only compound when you don't lose money. If I have a bond that pays 6% a year and I reinvest that 6% a year into the bond, that I can compound that return because I will never lose that 6% yield, right? In the market, if I have just 1 year, if I'm making 10% 1 year, 10% the next year, 10% the third year, I've got a 30% total gain, 10% average return a year. If I lose 10% in the fourth year, I now cut that 10% average rate of return to 5%. Just for 1 year's worth of loss, and it now takes me 30% next year just to get back to even on terms of my 10% average rate of return. Compounding returns only work if you don't lose money. Yep. And this is the big fallacy. And this is why when you look at, people say, oh, if you just invest money, make 6% a year, you'll be a millionaire by the time you get to retirement. No, you won't. Because along that way, you're going to have 10% down years, 20% down years, 5% down years. That's going to happen along the way. And at the end of the period, when you look at the performance gap between what was promised and what you actually got, it's going to be a fairly significant gap. And this is why it's very important to make sure that your portfolio is designed to generate a set rate of return over time. If you truly want to compound your wealth, build your portfolio to reduce volatility to as little as possible and create a steady rate of return structure over time. Let me ask you a question, just to think about, especially you guys in the chat. Would you rather have 12% market returns for the next 10 years with relative volatility? In other words, that along that way, you're going to get 12% returns, but do you run the risk now of having 10% drawdowns, 20% drawdowns, 30% drawdowns, whatever it is? Or would you rather have a investment that will just yield out 8% a year and no downside risk? Which one do you think you're actually going to be better at, potentially over time? And what actually gets you towards your goals on time? The 12% sounds great. The 10 or 12% sounds great as long as you can withstand the volatility. Most people can't. That's where they make all their mistakes. Versus these are just hypotheticals, right? There's no instrument right now that does this. But if somebody could give you an instrument that just paid 8% a year with no risk, would you not be better off in that?
And could you stick with it?
But when the markets are generating 20, it's like, and I saw this back in 1999, right? Yeah. This was hysterical back in 1999. Bank CDs from a bank were paying 8%.
I remember those days.
Yeah.
Yeah.
I could not sell my clients at all an 8% CD because of what was going on in the markets.
Yeah.
3 years later, they were begging for the CD. They weren't available anymore because interest rates plunged and you couldn't get an 8% CD anymore. But they would have given their hind teeth to get that 8% CD in 2002.
So even a couple years ago, I mean, I remember at that time money markets were paying like 7.25%, right? But even just a couple of years ago, when the Fed was, when rates were really low, and money markets were paying nothing. How many calls did I get from folks saying, John, look, hey, I have these assets. I really just want to find a place to park them where my money's liquid, and I want to generate 3 to 4% a year.
Yep. I'm so happy. If I can just get 4% a year, I'm happy.
If I can just get 3 to 4% a year, that's all I need. And my exact words to some of the folks are like, well, look, I'm looking for that too. Because if you can find it, let me know. Yep. But it just, that particular investment at the time, it didn't exist.
Right. Well, no, do you remember the whole T-bill and chill thing?
Oh, yeah.
That was going on at the time? It's like, I can get a 5% T-bill. I don't care about what the market does. Just give me 5% T-bills.
Yeah.
And I was saying then, is like, that's going to be fine until the market starts cranking out 10, 15% rates of return.
Yeah.
Right? And those very same people in T-bill and chill are going, how do I get back into the stock market now? Because it's already ran off without me. And the 5% yield is fine, as long as you're truly happy with a 5% yield and you're not looking at every other relative performance of every other asset.
That's it.
But as humans, we don't do that.
Yeah, that's just how we're wired. It's very emotional, and I get it. And I think that's how this underlying theme that I'm seeing as of late. It's as investors, we're all not all of us, but I think there's a big percentage of investors out there that are really focusing on one particular investment in their portfolio that's either doing very well, or there's one position in their portfolio that is not performing well at all, but they are forgetting to focus on the bigger picture, and then they're looking for something to maybe fill that gap, and then this kind of leads to a little bit more of that performance chasing. But even as I'm visiting with folks and reviewing financial plans, because we want to take a look at what is that rate of return that they really need moving forward for them to be successful, kind of let alone what the market's doing, right? But as I'm going through and reviewing portfolios, sometimes I get concerned when we look at some of the returns on some of the positions in the portfolio last year, like Palantir, GE Vernova. I mean, those are home run returns. If I could kind of relate this to baseball,
right.
in my opinion, it's almost like I think the approach really should be, let's just stay consistent, let's hit singles and doubles, and let's just get on base, right? Let's just be consistent over time. There will be home runs in the portfolio.
Sure.
There'll be times in the portfolio where there might be something that you strike out, okay? But where I get concerned is where, oh yeah, look at that Palantir, look at GE Vernova.
We need more of that.
We need more of that. But then we look at what Walmart did last year.
Look what Walmart did yesterday.
Yeah. Well, nobody's talking about that. I want this. It's like it's all, it's just trying to bring that focus from that one, look at this, it's doing so well, why don't we have more of this, to let's just really focus on the bigger picture. And for the amount of risk that you are taking, what was the total return that you received? Yeah. And is that supportive of what you need longer term?
Yeah. This just to kind of wrap this up.
Yeah.
This is the funniest thing that I see happening in the markets is everybody idolizes Warren Buffett. Is like, Warren Buffett created a 6 million % rate of return for his clients, right, over the history of the fund. And everybody says, well, I just want to invest like Warren Buffett. Warren Buffett never chased performance.
Yeah.
He owned a lot of assets that did nothing for a very long period of time, right? And he would buy stuff that maybe didn't work for the first few years, and then did gangbusters, right? But he was buying fundamentals. He was buying value. He was a disciplined approach, and that worked over the long term, right? It wasn't about chasing performance from one year to the next. So we all say, hey, we want to invest like Warren Buffett, and then as soon as something takes off, it's like, Warren Buffett who? I'm going to buy this. I'm going to chase what this guy on YouTube told me to buy because it's going up. And that's the real challenge, is that the way to succeed long term in investing is to establish a discipline and manage that discipline accordingly. I don't care what your discipline is. You can be a value investor, you can be a growth investor, you can be a combo investor, you can invest in momentum, you can day trade, whatever it is. Just have a defined set of rules, a defined process, and then follow that process. And if you have a defined process that's logical, right, that actually makes sense, you can do well in markets over time. The problem is that most people don't, and most advisors don't. And most advisors are just like, I can't really manage money, so what I'm going to do is I'm just going to put all my clients into ETFs because that way I don't have to worry about managing them. And then when something blows up in the market, it's like, well, the market's down, of course you're down, right? But you can do better than that by actually managing your portfolio and managing the risk. Are you going to beat the markets every single year? No, absolutely not. That's not your goal. Should not be to beat the market every year. Your goal should be to beat the markets over time, over a length of period, and more importantly, not even to worry about beating the market so much, but just getting to the rate of return you need to meet your financial goals without destroying all your capital in the process. Because if you lose all your capital, you're out of the game, right?
Yeah, and that's it, right? I mean, and I think the media has turned investing into a game of, well, how are you doing compared to the market?
Yeah.
Are you beating the market, right? And I think sometimes that really gets to investors out there. But you hit the nail on the head. We have to figure out, regardless of what the market's doing and what asset class is hot out there, we got to put all that noise aside, and we really got to sit down and figure out, what is that rate of return that I need? Because my rate of return need is probably different than Lance's. My rate of return need is probably different than Brent's. So the three of us may all have different ways that we approach managing our portfolio, and that's okay. Yeah. And if my approach is different, maybe Lance is more aggressive than I am. So maybe he's up higher than I am last year. Maybe Brent's positioned more conservatively than I am. So maybe I had higher return than he did. It doesn't matter. What matters is, are you structuring your portfolio in a way that truly supports your goals and objectives? And that's what you got to figure out first. What is that hurdle rate? And then from there, you can really back into a strategy that really makes sense for you for the long term.
There's a really good comment in chat right now saying, get a plan and stick to the plan and execute the plan. Absolutely right. Yeah. Go one step further with that. Write your plan down. We've talked about this before. Is that I'm going to have to write an investment policy statement for an article and just put it out, just so people can look at what an investment policy statement should look like. But if you can't write down your investing philosophy, and I'm talking about being very detailed, not just I'm a value investor. No, that's not it. That's not what it is. Write down on a piece of paper, how do you pick stocks? How do you find stocks? How do you define the risk profile of that position? How do you size that position in your portfolio? What are your triggers for buying and what are your triggers for selling? Write all those down onto a piece of paper. If you can't do that, stop everything you're doing and go do that. Because if you can't get that written down on a piece of paper, that means you don't have a strategy. You don't have a plan to execute because you didn't write one down. Writing it down crystallizes that strategy. And also, too, by writing it down, you're going to start finding flaws in your strategy. Like, oh, I just wrote this, but that kind of conflicts with this up here, so I've got to rework this out. So you write this down and then follow it. Leave it on your desk. Put it in a binder, put it in a folder, put it on your desk, and every time you go make a trade, I'm going to go buy this today, go look at your plan first. Does it fit within those parameters? And if it doesn't fit within those parameters, don't buy it. You may be going, but I'm missing out on an opportunity. Maybe, but if your strategy is sound, if you have a good investment discipline and you follow it, you're going to win over the long term where other people aren't. So again, goes back to chasing returns. We're all of us are driven by performance. We all want, look, I have a job. My job is to create performance for our clients, and I do the best I can to give them better rates of return than what they actually ask for. We work on that, or whatever their plan calls for. I try to deliver better. I try to limit the downside risk that occurs, that's going to happen in the markets. We work hard on trying to limit that risk to the downside. But it's all about a discipline. And if you can't focus on that discipline, you're going to put yourself in a more perilous position of destroying capital over time.
Yeah, and if it's very emotional. Yep. All of this, it's so emotional. And so if you find that this is very overwhelming from an emotional standpoint, then talk with your advisor, reach out and reach out to your fiduciary. Make sure they're a fiduciary, because you always want to make sure that you're working with somebody who's putting your interest ahead of their own, right? It's very important. And if you're not working with somebody right now, or you just need to bounce some ideas off of somebody, reach out. We're here to help.
Yeah. If you'll go to our website, realinvestmentadvice.com, and go to the blog at the top, resources tab at the top. Click on that button, you'll get a drop down that has a list that says our blog, our newsletter, those type of things, our daily market commentary. At the bottom of that is our ebook library. And if you go into our ebook library on our website, I actually have 2 different ebooks there. One called Real Investment Advice, which goes through a lot about managing money, managing risk. It's a great printout to give to your kids or whatever it is to help them kind of start focusing on, the rules around managing money. And then there's also the Investor's Trading Guide, which has all the rules. There was a comment here about, having a set of rules. I've actually published an ebook with a bunch of trading rules from the most famous investors over time. And it's just a list of about 181 different rules from different managers, whether it's, Warren Buffett or Paul Montier, et cetera. Those are all in there. But it'll give you, and again, you don't have to use all 180 rules. That's not the point. But, pick a guy that you really like and say, this guy's kind of mentality fits mine, and there's his rules. And here's the interesting thing about every one of them. They may say it differently, but every one of them say buy low, sell high in some shape, form, or fashion, right? So nobody, again, this idea of just buying and holding, every great investor, no great investor in the world buys and holds. Right? They manage their money over time. So anyway, both those ebooks are on the website, realinvestmentadvice.com. It's under the resources tab. I certainly encourage you to download them. They're free. I've got a new one coming out that we're working on right now called The 10 Immutable Laws of Money that we'll be talking about here on Two Dads on Finance. But you'll have that ebook as well to download for your kids also to help them do better. And again, when I say kids, I'm talking about your kids of whatever age. They probably need some help.
They're still kids.
They're still kids. They're kids until I'm dead. So anyway, all right, that wraps up the show for today. John, thank you so much. Appreciate it. All right, get by the website, realinvestmentadvice.com. Be sure and like and subscribe to the channel. We appreciate it very much. Hope this conversation was helpful today, and we'll be back tomorrow with live Q&A with Danny Ratliff. So have your questions ready for tomorrow. We'll get into those, and have a great day. See you tomorrow.